Hello, everybody. It's Michael here again with your latest installment as we build up on the supply and demand processes and knowledge base, foundational information to help the trading community. I hope you all had a great Christmas. It's Boxing Day today, the 26th of December. Just got 5 days left in the year. I hope you had fun if you celebrated with your families and looking forward to the new year, improving and stepping up in your lives. So today I'm going to use a couple of questions that I got from contributors on the Trading Institutional Order Flow thread on Forex Factory as the basis for what we're going to talk about today, which is understanding where you are on the price curve and also confirmation entries. Confirmation entries are probably the most talked about and asked about topics, along with obviously momentum lines and trend lines. Within the methodology, people always want to know about it and often struggle with the concept. So hopefully today I'm going to break it down for you all in a way that you'll understand and it'll embed. So the first thing we're going to do is talk about Zico. I hope that's how you pronounce your moniker. It's easier for me to say it that way. Talking about how you identify buy and sell areas between the curve supply and demand zones. Looking at the popularized third and two-thirds split that Online Trading Academy use. So let's go to the chart and answer Zico's question. And then we'll come to the next question from Snake about confirmation entries. And I have a trade on natural gas that I took and I'm still in with a very small position, but I will show you and use that to explain confirmation entries. So about the understanding of curve delineation, how you divide up the distance between your curve supply and your curve demand. That's really what it is. And I will show you an example. So we're looking at the US dollar Singapore. It's a random chart that I just picked. I could have picked anyone. So as you all know, if you've practiced the methodology for any length of time, one of the first things to do is to understand where price is on the bigger picture as we do our multi-time frame analysis, our top-down analysis, various names to describe the same thing. So we start, as we've talked about in previous videos, with current price, and we're looking up and left and looking for big imbalances in price. So the one that is obvious to everyone is that. That's the current supply above current price. And when we go down and left and looking for a big move, we find that. And that is the current demand below current price. And this is your big picture. Now let's take a second to talk about what big picture means. All big picture, or curve, as some supply and demand traders refer to it as, all it means is the trend that you are trading. It is the trend that you are trading. What you're doing with your other time frames is refining your entry, understanding how the trend on this chart is moving, when it's pausing, when it's turning. That's what you're doing with the others. But you're really trading the levels on this chart. So if you were starting with your weekly chart, for example, you're going to be trading weekly levels. If price is not at a weekly level, you're going to be very careful about entering trades. And that is where this discussion about the curve comes in. If prices are not at this weekly supply and they are not at this weekly demand, where are they currently relative to this supply and relative to this demand? Now, there are a couple of ways that supply and demand traders try to identify that, and one of those ways was what Zico was talking about with the method of dividing that distance between this supply zone and this demand zone into thirds. Some supply and demand traders divide it into half and measure from the supply to the demand. And I'll show you two methods. Again, there are various ways of doing these things within this methodology, at least, and I'm sure within other methodologies. And let's go to the curve. So what I've just done is start from the proximal line of the supply and pull my measuring tool, which is just the fib, to the proximal line of the demand. Proximal to proximal. Proximal of supply to proximal of demand. You divide that distance into 3 parts. Actually, it's 5, not 3, as I think Zico mentioned, because you're also looking at the supply and the demand zone itself. So as we can see, prices are currently in the neutral area. They're around 50% of that distance between proximal supply and proximal demand. You, within your decision matrix, which I'm hoping many of you have, if you haven't, I would suggest, if I may, for you to work on that during these holidays into the new year. Your decision matrix, what you must see, your algorithm for you to take decisions. Very, very, very important. You can't trade without it. So right now, with this measurement, we say we're in the middle. Do we want to be, as is said in the community, diddling in the middle? Not ideal. Not ideal. Could you go down to a smaller time frame and want to look at the trend and maybe find opportunities? Yes. The probabilities of taking trades in the middle, you have to understand, are less than taking trades at the supply or at the demand, just so you are aware. So to recap, before we move on your chosen, and you choose this, on your chosen big picture, that could be a weekly chart for you, it could be a monthly chart for you, heck, it could be a yearly chart for you, that could be a 4-hour chart for you. Some of my traders on the round table, they use a 1 hour, because they're scalping, they use a 1 hour as their big picture. Literally 1 hour supply, 1 hour demand, wrap lines around it, around price, and they trade level to level. This is what it means when supply and demand traders are talking about trading level to level. They identify their big picture supply, whatever their big picture is to them, and their big picture demand, and they trade price between those two levels. What we've done is measure the distance between proximal supply and proximal demand using a fib tool that has been modified to show 67%, 33%, and I added the 50%. You don't have to do that, but I like to add that. Okay. The second way of drawing this measurement is going distal to distal. Now, what does that immediately tell you? It doesn't differ that much, right? Doesn't, because prices are still around the neutral area. But what it does do is immediately tell you that if you use this approach, price location is going to be very dependent on how big, how volatile, how wide your supply and demand zones are. If your supply zones are wide, if, for example, this zone, the distal line was up here, and for your demand zone, say the distal line was there, it might make a difference as to where price is at the moment. The advantage of this methodology is that it keeps traders consistent. Why? Because remember in the last video, what was the one price level in a supply zone and the one price level in a demand zone that supply and demand traders agree on is the distal line of supply, which always goes at the highest high in the base, the distal line of demand, which always goes in the lowest low of the base. Remember, we said where we have discretion is the proximal line. So if I drew my proximal line like that, for example, that would immediately have an impact on where this line or where prices would be located. If I drew my proximal, my level, instead of going, if I drew it to that, suddenly it has a slight influence on where price is located. So if I drew my zone like this, it might make it more scrunchy and make you think, where am I on the curve? Am I there? That's if you widened your zone. So all of a sudden your middle area is smaller, but your extremes are that the areas below 33 and above 67 are wider. So those are, again, as we said last time, advantages and disadvantages of everything. If you put it distal to distal, it's one way of doing it. Put it proximal to proximal is another way of doing it. No magic, no drama. You decide. You test it out yourself and you find the one that suits you. There isn't one that suits everybody. There is flexibility because there are individual characteristics in all of us. So again, remember what I always say, don't be boxed in. Don't allow yourself to be boxed in. When you do make a choice though, stick with it. Be consistent with it. Don't draw it sometimes proximal to proximal when it suits you. And then other times I'll draw it distal to distal when it suits me. Pick one. Please. It'll help you with your consistency of approach. Okay? All right. So Zico, I hope that explains it. Now, just to button up on that one, the reason this is done is because there are decisions to be made dependent on where price is located. As I started to say earlier, if price is in the middle, you might have a decision matrix that doesn't allow you to take those trades. You just have to move on to another market. If prices are located currently in the middle, you don't want to diddle in the middle. You might want to wait till you get down to demand or up to supply and just move on, right? If you had a decision matrix that said, right, prices are in the middle and you have an approach that would allow you to take trades, whether those are breakout trades or trading into supply zones or following a trend on the smaller time frames, then do that. Okay? There are a couple of don'ts. We do not sell when you've delineated. The probability of your sales succeeding decrease the closer you get to the demand. Obvious. Right? That's obvious. But what this does is help you actually see where is low between this price range of supply to demand. Where should I be easing off of the shorts? Where should I be easing off of the longs? If I'm above 67%, do I really want to be putting my full position size or even taking any trades above 67%? That's a question to ask. But what doing this exercise does is help you objectively delineate those levels. Okay? I use that term objectively a bit loosely because there will be some occasions where the curve is not this clear. Okay? So that is where the discretion also will come in. You must have a consistent approach for choosing your levels, how you choose your levels, okay, so that you can ignore certain levels because they don't meet your criteria. But remember, that's you putting a filter, as we all do, on the markets. The markets do not have to obey our filters, but we've studied them, we've back tested them, we've forward tested them, we've developed our own nous as to what we're looking for. Okay, for example, as I talked to you guys last time, the color of my candles, they're things that I have tested my understanding of big imbalances, small imbalances, tight bases, all of those kinds of things. I've coded those into the colors of my candles, and it just helps me visually. That's all. Okay, so I would encourage you to do the same. So this is the work, Zico, that you would be doing on your curve time frame. Okay, I hope that helps. So I've given you a couple of ways to draw it. I've given you the understanding and the underpinnings of why and how you do it, and the decisions you have to make depending on where price is in that location. Either do nothing, sell, buy. Chill on the buys, chill on the sells. That's really it. Okay, I hope that helps. So we'll go to the next question, which is Snake's question on multiple time frame analysis and how to manage alerts. Snake, the alerts really for trading view, the alerts are as simple as you setting them before a zone. So I'm going to take you to Nat Gas, which is a trade that I'm still in, but I took this week. It was quite an interesting trade. And I'll walk you through my thought process and use that to explain multiple time frame analysis. So I start with the weekly chart. That's my chosen big picture levels. Okay, that's just what I do. So I had a couple of levels that I was looking at in here, and this is all pre-planned. I'll show you. In fact, let me show you the picture of what I was looking at, because I took a screenshot before. In fact, I had two choices to show you: the US dollar Mexican or the US dollar Mexican or the natural gas chart. So I'm just going to show you what's up with my pictures. It keeps disappearing. I'll show you real quick. So that's the chart of natural gas that I took as the trade was being entered. So this was the level, and I'll show you when we get to the 8-hour chart. This was the level that I took. Notice the way I drew my level here. There's a reason I drew this one there, because I was building a position in natural gas in here. So I drew it from wick to wick. Okay, I could have drawn it to the body, the origins, and I did, because there were, as I said, positions built in this price range. I wanted to see the price range to build my position in. Okay, so that was the 8-hour chart. And you guys, if you're watching Nat Gas, you know what's happened after this. Okay, you'll notice this is not, and I can show you the recordings of where we discussed it on the round table. But so that's, I'll bring that chart back a little later on. So let's continue. So those were the two levels I was watching. So here's me doing my homework, preparing, looking at natural gas. What am I seeing? Well, I'm looking at natural gas. I see that it started to do something odd. It started to crack these lows in here, which is not a good thing. It shouldn't be doing that. So I was watching it. Natural gas is one market that I trade. And then prices came into the demand zone and it held, but then it didn't get very far. This is what within the Wyckoff methodology, which is something that I'm trained in as well, is called a shortening of the thrust. Basically it means that the momentum is dying out, but you wouldn't take a trade just based on that, but it was something I noted. So the difference between these two highs was not as much as, say, for example, the difference between this high and this high. The distances are very, very much shortened. Okay, that's shortening of the thrust. Okay, so that all those observations were noted, but prices were still up there. And then we had a crack. The significant point for me was when we broke and close below that low. Break below is enough. Close below is better because it's more confirmation. That's all. There's no drama to it. Okay, so that was when we started to watch these two levels. Okay, I took a trade in here. It worked for a couple of weeks, and then it eventually came out and stopped me out on the rest of the position. And if I take you real quick to the daily chart, you'll see why. That was the short, the first short at the first level, right into this supply zone. Yeah. Prices pulled back. This was the problem though. So I have a rule that if I don't have enough of a profit margin, which is something that I set for myself, you can choose a number you want for yourself, whether that's 3 to 1, 4 to 1, 5 to 1. If I don't have enough of that, I don't take the trade. So I took the trade up into here on a smaller time frame, and I thought it was going to move. I totally, whether subconsciously, unconsciously, or consciously, ignored this level because I really wanted to short natural gas. And the market said no. So it held. I noticed this thing was building higher lows in here. You'll notice the buyers kept holding it up every time after the initial pop, which was good, and I was doing my happy dance and all of that. It was not really falling as I expected because I was expecting it to come down to these lows again. So obviously we went into defense mode and managed to get out without. It was disappointing, but there was no bloody nose or anything. Prices still stayed on our radar. Natural gas still stayed on our radar. And then we were watching it, seeing what it was going to do. The next obvious level was up into here. So as I do, I tend to have two charts up like this. This is my setup normally. So usually I have this is a changeable chart that I can change into a daily, into a 4-hour. I change the time frame here. This one is always my weekly. Okay. But as you know, I use multiple time frame analysis. So this is the chart I alter. I always have the big picture up so I know where I am. And as we were talking about the curve before, this was the curve demand that was holding, and these two were the curve supplies that were above current price at the time. Okay, let me take that out. I will take this one out as well, and that one. So this was what we were looking at. So as I said, that was the initial trade. Didn't work out as we expected. Prices went through it, and they were now coming up into this level, which had two levels on top of each other, sitting up in there, which was good. We're fine. We're watching that, looking for it. Prices rallied up, tried to reach, couldn't make it, and then came back down. And you remember on the picture I showed you, the area that we had marked was this one because of the strong move away. No, that's all. That's the only reason we had it marked. That was this level. Okay, there was a little bit more supply above here, yes, but it wouldn't have really met. It would have been because of this. You would make sure that you had an eye on this one as well, just in case prices started to turn in there. Okay, so I had this level in, and what attracted me to this level again was something similar to what had happened on the weekly, the break of this low. Notice when this drop happened, it didn't reach the supply zone we wanted, and we started to see weakness, and that weakness started to take out significant lows. That was the low before this whole rally. Okay, so snake, we're looking at multiple time frames now, right? The alerts were set up in here to alert us if and when prices broke out of this zone as well. We got alerted. We had other alerts for when prices would get to these zones. We didn't have those. It stayed on a watch list, which we keep. I have a focus list that I update every week. It's part of my weekly routine. I go through all these markets you see on your right, and I pick the ones that are most appealing from a decision matrix point of view for me, that are in trends, that are at levels of interest, and I put them on the focus list. It's usually not more than 5 to 10 markets, a manageable number over all the, significant number of charts I've got in here, the markets that I observe, right? So I had my alert set. I was alerted. It was on my watch list. Then it did this. Remember, this is a daily chart, so we're looking at a lot of patience waiting for events to unfold. And they did. They did. So that line there, you'll see this line. I'm going to move it about. That's where it is on the daily chart. And that's why you want these charts up together so you can see where your lines are. And I've linked, you can see on the left here, I've linked mine on TradingView. So whenever I draw a line on a weekly chart that I've said show me it as well, and you can see in the visibility, that line appears on all of these time frames. Okay, so you can alter whether you want it to appear or not. If I didn't want it to appear on the daily, for example, and I unticked that, notice in the background how it disappears and reappears. I'm sure you know this, but there might be others who don't. So that was that area. So again, it's coming from way over here. That's the level right there. Okay. But internally now, more closer to price, it had broken this level. Significant event. Buyers were in here. They caused the last rally up. That's moved out of this supply zone, removed all of this supply to the left, but then showed significant weakness and again closed below all of these levels, below even that congestion area that caused the palaver that pushed prices up. Closed even below that with this candle. Okay, so we mark this level. We're going to trade it. Now, remember, within supply and demand, there are various ways in which you can enter. You can enter what's termed the classic set and forget way, in which you just place your order. Let's put some lines around this. You just place your order at the proximal line to sell. Your stops above the level. In this case, you might have needed a wider stop because you had this long wick, or you might have to have managed your stop maybe above there. You really need your stop to be in a safe place, because what you don't want to do, this is just a tip for you, you don't want to put your stop here only to see it peekaboo come into that supply and then tank. You've just been stopped out and the market would have gone your way. The safest stop in this whole configuration is above here, which is a wide stop, isn't it? It's a wide stop. So you could, if you placed your entry there, your safest stop would be up there. You could try to put it here. It's risky. Oops. You could try to put it there. It's risky because it's inside a supply zone. And one of the rules that I have is, as much as possible, I don't like to use the word never or always, the words never or always, because for me there's no such thing. It's just circumstances. It's context. Nothing means anything without context, as Denise Schultz says. Yeah. So where your stop would be in this trade would be quite wide. But if you were using a confirmation trade, coming to the specifics of your question, Snake, and I'm taking my time with it, so that people can understand where we're at. 29 minutes. Okay, that's fine. For those of you with short attention spans, I'm sure you can pause and come back to it, but it's more important to me than that you understand the processes. Okay, so prices then enter. We don't take the trade in here because of the wideness of the stop. And this is my thinking process. I'm explaining to you exactly what I did and what I do consistently, how I make those decisions. So I want to use a confirmation entry. What's called a confirmation entry? It's really a misnomer. There's no such thing as confirmation per se. It's again, what's the market presenting us with? Because we, in the modern age now, we have computers and we can go down time frames, even up to 2-second charts and 5-second charts. We're in a better state than people who were trading in the 1930s, 1940s, even for some people in the 1980s, where all they had were monthly, weekly, daily charts. We were trading in those days. We would have had to take that trade and not be able to go closer in with our microscope, i.e. multiple time frames, to look into what was happening in here. So let's do that now. So we'll go into this area, and I'm going to open this chart up. So we're on the daily now, and we're going to go into the 8-hour chart where that trade was taken. And here we are. So these are prices rallying into a pre-identified daily supply zone. What do we notice again? These patterns repeat. Prices come in strong, everybody is happy, demand zones are down here, prices are moving to higher highs. All of a sudden you see red, blood on the street, and breaking of significant levels. That was the last low that carried prices to new highs. Prices went below it, even closed below it. Yeah, at least once, if not twice. And now I was ready again to show you the picture. That was what we were looking at, just to put it side by side. Can I make this bigger? Yeah, so that candle there is this candle here, right here. So that was the picture. As you can see, those levels were drawn in, but this is where we were looking at it. And this drop here was, you see the line I drew there? It's exactly what I've just drawn in gold here for you on this current chart, but I had that line right there. I hope you can see it right there. Okay, as this is a significant event that's taken place. So then obviously drew my zone and I started building positions. And this is where I was able to buy, or rather to sell, at the proximal for the first entry and in there for the second entry. That's how I built that position. Okay, I was able to do that because of the size. If this candle was any bigger, I wouldn't have been able to do that. I would have not done that. But I did that because I was anticipating there was going to be a significant move, and the last thing I wanted to do was to put my entry there and not get filled. Okay, so I decided to build my position rather than entering it all at once. Okay, and I did that successfully, and I stayed in the whole trend. I've been in this trade since this candle on the 15th of December. And I stayed in the whole trend. I still have about 20% of the position left, and we have made new lows. Okay, so that, in a nutshell, Snake, is the process of doing a multiple time frame analysis of any chart. You start with your big picture. You identify your levels, as we did on the weekly chart, remember. We identified our levels of interest. That was demand. If you were, skilled enough to take those bounces, you were in the trade, you would have obviously had to come out at this level for profit. But we identified our supply above and current demand in control below, because prices had not broken through it. We rallied, we took out supply, which means there are buyers down in here. Prices went up, they came back and tested those buyers, and then they tried to rally up. Now, I was definitely interested in shorting this because My analysis, as I said to you guys earlier, was this was a significant event. If this market was in a strong uptrend, the shortening of the thrust and then the breaking down to new lows below a significant, important pivot low shouldn't have happened. But it did. So that's why I was more interested in the short side than in the bounces. Okay. Now this market could come back in here now and rally all the way back up into our supply up there. That's fine as well. Trade is done pretty much. I've made a significant amount. It's been the largest trade for me for this month, and it's been the bulk of the gains. So that's the big picture. For me, it's the weekly chart. Levels identified. We go down to the daily chart and we start refining our understanding of price action. All we've done is take a microscope and dial in closer. That's all that multiple time frame analysis is. You're now looking at more closely at how price is doing what it's doing. That's why this level popped out and was important, because it was the last low that carried prices right through all of this congestion, the supply that initially caused some selling but then got bought up. That was a significant low. And also that's why this was a significant event, when prices traded very strongly right through it. So then we waited. Notice there's a lot of waiting. Why? Because the time frames I used were large. If you were doing this on a 1 hour chart, on a 5-minute chart, your waiting time will be less. It all depends on your personality, the time you have, your availability to be in front of your screens. I'm fairly patient, I think, sometimes. So I don't tend to, when I started out trading, I was on the volume charts and futures and on the tick charts and on the 1 minute, 5 minute. I've done all of that. But as you all know, my life circumstances have changed significantly with the challenges that we face with my son. So I've had to reinvent myself in the last, not quite 10 years yet, maybe 8 years. And now I'm on the bigger time frames. So that's what we've got. We look now closely at the daily chart and we're saying that's a level of interest right there. That's a level of interest that I want to hone in on price when it gets back into that level. I really want to hone in on it because I want to see what it's doing. And for me to look more closely into it is for me to go, I could have gone to 4 hour. I choose 8 hours. It's 3 times, dialing down 3 times less. So zooming in, magnification of 3, basically. And that's where I saw what it was doing when it arrived. It arrived strong, didn't it? It arrived very strong. And then a little bit of selling and it went to new highs, and you're thinking, this thing buyers keep coming in and saving this market. And then whack. That shouldn't have happened. The buyers should have protected that low, but they didn't. Okay, so that's a problem. And that's where I identified that supply that I want to sell when prices come back in here. And some news came out. Yeah, it was that natural gas supplies were or the availability of natural gas supplies were much less than expected, which you would think would be good. And it was for 8 hours for this market, that, the demand, that there was less supplies, and we're in winter, we need natural gas. Everybody talks about the seasonality of natural gas. In winter, anything that produces heat, you don't want to be shorting them, is what we're taught, that because obviously we need more heat in the winter. Right? So anything, whether that's heating oil, whether that's natural gas, even crude oil, to a degree, they all have this seasonality in the winter months, in December, January, that you don't go short those markets. But the charts were telling us different. The charts were telling us different, that this market was beginning to struggle. in here. So I sold here, and this is the one time that supply and demand will actually help us to quote unquote catch the top. Is not something you want to be doing on a regular basis. And you see all the rigmarole I've had to go through to be able to even take that trade, because the last thing you want to be doing is the one picking the top or picking the bottom. People who pick bottoms get smelly fingers, guys. A little humor there. But the guys on the round table know I say that a lot. We don't pick bottoms or tops, but we can use the methodology sometimes to be able to get in very near the top. Okay, so even though the news was good and prices came in real strong, they came into our supply zone, we shorted it, and we held on for dear life. Yeah. Now, to finish off, Snake, I hope that helps you, but last little, I hope, useful observation is, what about, where is that box? What about that supply zone? That's what type of supply zone? That's a drop, a base, and a drop. Why didn't you short there? Why did you decide to short there? Good question, if you asked. 2 reasons. Firstly, the move away was not significant enough for me. Yeah, it was important, but it wasn't significant enough given that we had this just below. And the second, and I think more important reason, was what I was talking to you guys about just a few minutes ago, about if I shorted here, where would my stop go? My stop would we're all taught to put your stop just above supply, right? Well, if I did that, my stop will go right into this supply zone. And I've learned over the years, and that's why I'm mentioning it as an important sort of observation, not to put my stop into a supply zone when I'm shorting, and not to put it into a demand zone when I'm buying. Okay, because I don't know where prices are going to turn, right? What I do see is a level on top of a level, which is probably one of the, other than a gap, it is probably the second most, in my experience, formation you can have within the supply and demand methodology. A level, whether that's demand or supply level, a level on top of a level, right above it if it's supply in this case, or right below if it's demand. They're stacked, if you like, stacked levels. Yeah. So if they manage to get through one, they've used up a lot of ammunition and are less strong by the time they're getting to the upper one. So those were the reasons why I didn't take this second one. And actually, I liked the fact that it was there. I was grateful for the fact that it was there, because I knew once, this happened, that a lot of energy, again, building all those confluences together, everybody, building that narrative together for me to be able to, put size on this trade. And I did put size, and it's worked out. I've exited as we've gone. Every time we've made significant lows, I've exited there, and I've got the rest of it locked in already. Okay, so I hope that helps. I'm really sorry about the length of the video. It's over 40 minutes now, but I had to answer Snake's question and Zico's question, and I thought I'd use it as a platform. So I hope you like it. Please, I'm told my daughters tell me, tell them to click the like button. I hardly ever do that. So like it, subscribe it, please, share, subscribe to the channel, subscribe it, seriously. Subscribe to the channel. I'm not very good at this thing. I just trade. I don't know. So please subscribe to the channel. Click on the like button if you like it, and share it with your friends. Let's get the knowledge out there. There's no drama. There are no secrets. The markets are what they are, and let's help each other grow and develop. I wish you all a very happy new year, and that 2023 will be a better one for you and your families. Look after yourselves, and if you have any more suggestions for other videos you'd like to see in the series, put them in the comments below on YouTube, or put them on the Trading Institutional Order Flow thread on Forex Factory, and I'll see if I can help out. Take care, everybody. Happy New Year.